Hi, this is Jim Cunningham. We're going to talk about retirement ready or retirement readiness 2025 financial planning essentials and RMD, which is required minimum distribution strategies. Now, you might think, I have an IRA, I just take my RMDs. What's there to strategize about? Well, there's a lot that you can do to minimize your overall tax bill. So remember, these IRAs are this just big juicy pot of money that has not been taxed. So if I were running the federal government, I would be looking at IRAs as a way to don't tell anyone, but I would be looking at IRAs as a way to raise a lot of revenue, a lot of federal revenue. And we're going to talk about ways where you can minimize the amount of money overall going to the government over time. So if you're watching this on YouTube, please subscribe to our YouTube channel. We release these videos about once a week, typically at 6 p.m. on Thursday, and we have over 200 videos on our YouTube page, so check it out if you are not on our YouTube page. And what are the new limits? 401k limits. These change every year. These are indexed to, and I will put this in air quotes, inflation. As most of us know, the government kind of underreports inflation for a lot of different reasons, but things tend to go up faster. You know, you may see nominal inflation at like 3 or 4 or 7%, which has been recently, but you go, gee, prices are up on the stuff I buy. They're up 30, 40%. How is this jiving? We're going to talk about how these 401k limits are indexed to inflation and do go up, and they're rounded up and down. We're going to understand by watching this video, you're going to understand the smart use of RMDs and qualified charitable distribution. So what is a qualified charitable distribution? Christina's going to walk you through that. Spoiler alert, this is instead of taking the RMD yourself, that RMD goes straight to a charity. And there are a lot of benefits to that. You may think, well, if I take that money, don't I get a charitable deduction? Not always. And sometimes taking that money has other outsized consequences that are negative. And see how the Secure Act 2.0 changes things, raise the RMD age, the required minimum distribution age. So what that is, you have an IRA, you reach a certain age, the government says you must withdraw from this IRA, depending on the type of IRA that it is. And then also increase in catch-up limits if you are reached a certain age, you can put more in, and better access to, and this gives better access to part-time workers. So a lot of people are moving to part-time work, you know, especially in this age of a lot of remote work. A lot of jobs have moved remotely. A lot are coming back to the office. But, you know, we're living in a new world, certainly different in post-COVID than pre-COVID. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've got 30 years experience as an attorney. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law, a real estate broker, securities and insurance licensed, and a pilot single engine land instrument rated, but I am not current. And I'm also a third-generation pilot and second-generation lawyer. Speaking of lawyers, these are the lawyers in our firm. Lots of lawyers, lots of different backgrounds, lots of different capabilities. We are focused on the peaceful transfer of wealth from one generation to the next while minimizing taxes, right? So that's fundamentally what we're doing. We're giving our clients peace of mind. This is Christina, and I promise I will stop talking here soon, Christina, and I will let you take this show. But we have Christina joining us here today, as well as her partners Alyssa and Shannon, who are also listed on this slide. This is a very important disclaimer. I'm a lawyer. I'm talking. This should not be taken as legal advice. So don't go, well, Jim said, and I heard Jim say, and therefore I'm going to go do. This is really information, and we live in this incredible abundance of information. If you don't know how to do something, I mean, I go on YouTube. If I don't know how to fix something, I go on YouTube, and I would say most of the time, Christina, you know, I don't know what your husband does, but I try and fix things. Sometimes I make it worse, but many times I don't. So this is your disclosure. Take it away.
Yeah, standard disclosure. We are registered with the SEC with our RIA, Cooper McManus, and then we are also FINRA registered with our broker-dealer, Cambridge Investment Research. So this is definitely not investment advice, as we're kind of going through just some basic updates in financial hygiene and information. So any specific investment advice should always be individualized and one-on-one with context to your entire situation.
All right. Basic financial hygiene. This is the stuff. This is the basic adulting stuff. It's like washing your hands before you eat dinner. Okay. These are the real basics. And I will tell you, before we started, Christina, you were talking about a little bit of smoke. There's some fires going on. It's very important. If something happens in your life, you need to make sure that you have all this stuff buttoned down. So, what should people do annually when it comes to retirement plans?
Yeah, annually, it's always good to review beneficiaries. You know, if you've had a new 401k set up, or if you've had a new change in employer plans, or you've had a death in the family, or any kind of a major life event, you definitely want to review who are those beneficiaries. Maybe your beneficiary has since passed or is aging out. I've had conversations recently in annual reviews with clients that, you know, their beneficiaries are quite a bit older than they are, and we're looking at designating, you know, different types of beneficiaries to address those concerns. So reviewing beneficiaries, or if you've had a divorce, or if you've had a legal separation, you know, typically in the state of California, it is a requirement to have your spouse as the beneficiary of a retirement account. Otherwise, it requires a spousal waiver unless it was part of a prenup. So reviewing beneficiaries is something that often gets overlooked, especially if there's been a major life change.
You
Um,
and I'm just gonna. I hate to interrupt you, but this is very, very important. And if you're listening to this, and whether you're a lawyer or a non-lawyer, it's very important to understand that a 401k is treated differently than an IRA. So,
mhm.
you can be married. If you have an IRA, you do not have to leave that to your spouse. You do not require a spousal waiver to name your spouse the beneficiary of an IRA. This is very, very important. It's different with a 401k. So we have had multiple cases when spouses die, the surviving spouse comes in, they say somebody else is named beneficiary in the IRA. Is there anything I can do about that? And unfortunately, the answer so far has been no. So there was a case that came out, and you'll remember this, Christina. A person who died had I think it was over $1 million IRA. They had named their girlfriend from 30 years ago as the beneficiary of the IRA. The girlfriend got the IRA. So very, very important. Check those beneficiary designations. And if you're married, you might want to check your spouse's beneficiary designations.
Well, and actually, typically on the IRAs today, if it's a new IRA being set up, it is we do still advise. We typically will see a spousal waiver request even for an IRA.
Good.
So doesn't mean that it couldn't have been done differently or changed, especially for someone that might be doing a self-directed IRA or setting it up online. We typically still get flags from, you know, a major custodian to say, hey, the spouse is not the beneficiary. There should be a spousal waiver here. Maybe it's a second marriage. So sometimes it might be that the spouse is beneficiary for 50% and then 50% is the children.
And what we're
So
talking about here, this is very important. We're talking about when the person who owns the IRA dies. That's what we're talking about, beneficiary. We're not talking about, you sort of assigning your rights to this IRA. But if I have an IRA and I die, who gets that IRA when I die? You look at the plan documents. This is really important. We covered this in other webinars. You don't look at your trust, right? You look at the plan documents themselves. So if somebody dies with a $5 million IRA and that trust says to leave the money one way, but the beneficiary of that $5 million IRA is different, that beneficiary designation controls.
correct. Yep. So account titling, also very important. You know, are certain assets in the trust or should they be in the trust? Sometimes people have opened up individual accounts or separate trading accounts. It could even be a, a crypto account for that matter.
Yep.
But if it's not in the trust, it could be subject to probate. Tax loss harvesting is one of those mindful things to be aware of. If you have multiple financial advisors or multiple financial institutions that are doing trading, it could be violating wash sale rules. What that means is, let's just say, for example, in December, we look to sell certain shares of Apple that we're trading at a loss for the year. So maybe there's some stock that had a $20,000 gain and some stock that had a $10,000 loss. We sold both, recognized a $10,000 gain. And to the extent that we took a loss, let's reverse that for a second. Let's just say that we had a $20,000 loss, $10,000 gain. So net, we sold both. We have a $10,000 loss. We cannot buy back that stock for 30 days. Otherwise, we violate the wash sale rules, meaning we cannot take that loss on our tax return. If you have Merrill Lynch over here, UBS over here, both trading accounts in your name, under your social, under your tax docs, and one buys Apple over here and one sells it over here, and you wanted to take that loss, they cancel each other out if it happened within 30 days. So that's one of the other benefits to making sure that you have consolidated advisors for tax purposes. And so that you've got one primary financial physician that has access to view your entire portfolio and coordinate better planning. In-force illustrations, I'd say that this is something that we should do at least every 5 years. It's one of those annual reminders of just like where are we at in the life insurance policy process as far as since inception. Are the policies performing as intended? And every year on the anniversary of your life insurance policy, if it's a cash value accumulating policy, any form of a permanent or universal life or whole life, it should provide an annual in-force illustration. And those are important to have looked at, reviewed, because sometimes they could be underperforming.
Yeah, and or they just kind of wink out of existence, right? They go, "Oh, gee, well, we're not. Things didn't go as we thought they were going to go." So it's very important to pay attention to that. Sometimes you reduce a death benefit. Sometimes you put more money in. You might do a lot of different things. You might do a 1035 exchange into a new policy. We talk about that in other
Right.
webinars. So very important to pay. And again, this is like paying attention to things, right? This basic and if you're a business owner, by the way, and if you're not meeting with your CPA in the third or the fourth quarter, for example, if you're going to file your taxes for 2024 and you're a business, certainly if you're a business owner or a high net worth investor, you should be meeting with your CPA in the third and fourth quarter to make sure that you're doing all the things you can do to minimize your income tax bill. I do that personally as a lawyer with an ownership interest in a law firm, and I know you do that as well, Christina.
Absolutely.
Meeting with
And
the
a lot of times
CPA.
we join those meetings with our business owner clients to
Right.
make sure to see if there's anything else that we can advise to do for tax mitigating purposes.
Well, breaking news. I will just say, a
Yeah.
few minutes ago, I did get a news headline that the Supreme Court is not staying the sort of the hold off on the reporting the beneficial ownership to FinCEN, Financial Crimes Enforcement Network. Stated another way, you have to we're back on, right? So FinCEN, we were on, we were off. The Supreme Court said, nope, we're going to hear this case in a couple of months. But in the meantime, you do need to comply with FinCEN. So for all those people who said, I'm not going to comply, it's back on. And, you've got a deadline this month.
What is the deadline?
We covered in other webinars, and I'm pretty sure it's the end of this month for the vast majority of people, the end of
Okay.
January. So
If they just, I was wondering if they gave an extension, if it just came out with an update.
I think there's some, if you created your company late in 2024, there might be some 10 or 15-day extension. Again, we covered this
Yeah.
in another webinar. You know what? Just do it because this is information. Frankly, I think that the government has already. They just want to make it easier to collect the information. So a little bit of Big Brother. But the spirit of this rule, and I think the Supreme Court ultimately will uphold it, is they're trying to stop the flow of funds for terrorism and organized crime. So, I mean, that there's a purpose behind it other than just spying on Americans. But what does this have to do with retirement planning? Well, if you're a business owner, obviously you're going to have to pay attention to FinCEN. And again, if you have not seen our webinars or other webinars out there in the ether, really pay attention to this because if somebody owns a part of your company, right, maybe a key employee who owns 30% of the company, and they change their residential address, you have to update that information with the federal government within 30 days. So you really need to pay attention to this. And I'll let you. Well, let me talk about corporate structure. Corporate structure is very important as a business owner because how do you minimize tax? How do you prepare for retirement? How do you prepare for sale? I would say you need a lead time of 5 to 8 years. So if you have a company, you say, I'm going to sell this company. How am I going to minimize taxes? So many of our clients, when they sell their company, they pay 50% in tax. And there's so many things you can do in advance of that to minimize that tax bill, maybe spread it out over time, defer the tax, avoid the tax entirely. Reviewing your corporate structure from a tax standpoint is very critical. Also, be mindful of you don't just willy-nilly put people on as secretaries or treasurers or these corporate offices where you're naming these people as corporate officers because there's liability that attaches with that for actions that person might take. So be very, very careful with that. And I'll let you talk about family payroll.
Yeah, that's another thing too, is to look at, the beginning of the year or in particular year end prior to finalizing any payroll. Is it advisable, especially if you're a business owner, to put children on payroll? I know that you can do essentially shift the tax burden to the child's tax rate and pay payroll tax rates as opposed to ordinary income. So those are some things for business owners looking at the corporate structure. Does it make sense to take a QBI deduction or do, pass through entity tax allocations? So those are things that, we want to make sure business owners are aware of and looking at before they really generate revenue for the year.
I will just say this family payroll. I was meeting with some clients yesterday, and they have 6 children, and the husband and wife own a successful business, and we talked about their kids are between, I don't know, 5 and 15, and the benefit, because a lot of people, they're really concerned about, how am I going to pay for college? So if you're a business owner, one thing you can do is you can pay your child. You can use their likeness in your marketing materials. You can have them lick envelopes. You can have them work in your organization, whatever it is. But when that child starts earning money, that could be the savings that you use to pay for college expenses. And there are a couple of other really cool things you can do. Number one, there's a tuition tax credit that the child could be eligible for. Secondly, is they can contribute, or you can put money into a Roth for them. And a lot of business owners do this for their children, where they pay their child, and when you have earned income, you can then put that money into a Roth IRA. And if you pay your $35,000 a year, you maybe put another, what is it, the limit now, 8,000 in 2025, Christina, you can put
7,000
7,000 into a Roth IRA.
Yeah, so I know I did that for my children too.
Yeah, it's great strategy.
2025. One of the other things too to look at is especially if you do systematic contributions to a 401k per payroll or a certain percentage, oftentimes it's overlooked to increase the limit. So last year's limit was 23,000. This year it's 23,500. There's a few nuances this year, and I always remind people, if you are turning 50 at any point in time in this year, you can increase your contribution and do a catch-up contribution of an additional 7,000. So your limit is 31,000 this year if you have attained age 50 by the end of the calendar year. So even if it's December 31st, you turn 50, you can put that extra $7,000 in.
Wait a minute. So if you were born December 31, 1975, you got
You're golden.
benefit. But if you're born January 1, 1976, sorry.
You got to wait. And here's another interesting one, is the super catch-up. So this is for the first time going into effect, where you've got that super catch-up. And that is a result of the Secure Act 2.0, that if you are 60 to 63 or turning 60 to 63, at any point in time during the calendar year of 2025, you can do a catch-up of 11,250. So in addition to the 23,500, the catch-up is 11,250. So it's not the 7,000 plus, but it's a total of 34,750 is what you're able to do to kind of catch up prior to retirement. Now, if you turn 64 in this calendar year, you're not eligible. It reverts back to the age 50 plus rules. So that's an interesting one as well. With respect to IRAs, the current limit is 7,000. If you're 50 or over, 8,000 to the extent that you have earned income. So we do get asked sometimes, can someone in retirement put money into an IRA? Only if you have earned income.
Right.
And SEP IRAs, those limits have gone up to the lesser of 25% of compensation, up to a maximum of 70,000. And simple IRAs have also increased. So if you have a simple IRA or employer plan that is a simple IRA, there's some other nuances with respect to simples, but they also allow that super catch up.
Yeah, it's interesting, looking at the difference between, so what's the difference between a 401k and a simple? Those are two different types of retirement plans, basically. So if you're a business owner, you could have a 401k, or you could choose to have a simple, and you can put more money into a
Yep.
401k than you can a simple. So this is why it's really important, especially if you're a business owner and you're trying to figure out this retirement. It's really good to work with someone like Christina. And we talked about a three-legged stool. We've got a slide on this. Your CPA, your financial advisor, and your estate planning attorney, your savvy estate planning attorney. Very, very important to have those three people working together, because I think this is a missed opportunity. If somebody's watching this and they go, gosh, you know what? I'm 60. I've got this simple plan. No one told me that I could do a 401k plan in my business. You would be able to defer, another $13,000 a year. Well, in California, that's going to save you $6,500 in income tax potentially. So we're not talking a small amount of money. It's the real savings and this sort of tax deferral that we talked about at the beginning.
Right. And if you're a small business employer and you don't have a 401k, a simple IRA could be a good option as well for small businesses. Less expensive to administer, and it's another option for you.
Not exactly simple though. I think that SIMPLE is an acronym. It is not an adjective. Okay, it's an acronym. So these are pretty complex plans, or they should call it not so simple plan.
Yeah.
And the other thing too is if you're an employer, we are in an increasingly competitive work environment. We're come out of COVID. It's a different work world than it was pre-COVID. There are so many challenges to staying in business, and being able to have something else that keeps people or attracts people to your organization. Having a robust retirement plan is one of those things. At least I believe it's one of those things that helps you attract and retain the best people.
Absolutely. One of the things that you mentioned at the very beginning, the government would be wise to go after those big dollars that are in tax deferred assets like 401ks, IRAs. One of the things that most middle class families in California, if you've got a married couple, married filing jointly, they are typically phased out of contributing to a Roth IRA. So Roth IRAs have an income cap, or if you have access to a 401k and are contributing to a 401k, you have an income limitation to where you cannot then have access to also do a Roth IRA. There is no limit on income to do a Roth 401k contribution. So if you're able to afford to pay the tax, and this takes some analysis sometimes with your financial advisors, what is that sweet spot? Maybe half of your 401k contribution should be pre-tax to keep you in the right tax bracket. And then half potentially should be post-tax, essentially paying the tax today at today's tax rates. If it goes into a Roth, it grows tax-free, it comes out tax-free, it has zero future required minimum distribution. So there are some advantages to a Roth, and if you can contribute to that within your employer plan, many employer plans today offer a Roth option, and that just means you're taking it and paying the tax today. So this does require some analysis.
Well, it requires a big old crystal ball too, because the other part of this, by the way, is let's say you put $10,000 into a Roth 401k. Yeah, you're paying tax on that 10,000, but if that 10,000 grows to 50, right, and then you take that money out in retirement, you're not paying any tax on the 10. You're not paying any tax. Well, you've already paid tax on the 10.
Right.
You're not paying tax on the increase, which is a tremendous benefit. And also, this pulls at a thread on a sweater, Christina, which is,
Yep.
let's take someone who's got 500,000 in cash in their living trust, 500,000 in a traditional IRA, and 500,000 in a Roth IRA. I would suggest that those three buckets are going to be invested differently. You would have a different investment approach in your Roth. That's probably where you want to have your growth, would be
your highest aggressive growth returns.
And then your IRA, you're going to be having that a little bit different. Your tax-free bonds are going to be in your living trust. You don't want to have tax-free bonds in your IRA, frankly, or your Roth, because you're paying a premium. You're paying to get that tax-free benefit. So we just don't see tax-free bonds in a traditional IRA. We don't, right? Why?
No, a lot of times it's what we call asset location.
Right.
We want to have the right assets in the right location. So, as you mentioned, your tax-free assets, more your tax-free bonds on your trust assets, capital gain assets, dividend assets, highest growth in the Roth, and you still want some pedal to the metal in an IRA, depending on your exact situation. But you don't want to not take advantage of either tax deferral, compound tax deferral, or compound tax-free growth.
Yeah, and I was talking to a client who slight sidebar, but I think this is really high value information. I was talking to a client who's 82, who has required minimum distributions from his IRA, and he's got about 500,000 in the IRA. So not, 500,000 is a lot of money, but in the world of IRAs, it's I would say it's common for people to have 500,000 or more in an IRA. And we had this conversation, which is, do you really need the money that's in the IRA? Do you really need those minimum distributions?
Mm.
Those, the 5%, that 25,000 RMD that's coming out. Do you really need that money? And the answer for many people is no, I don't need it. This dovetails into the qualified charitable distribution, which you'll be talking about. But the other thing I think is really a shift in mindset. I think if our firm is all about the peaceful transfer of wealth from one generation to the next, minimizing loss to divorce. If your kids get divorced or grandkids get divorced, that can wipe out an inheritance. But a lot of people who have IRAs, especially if you're in your 80s, that money could very well be multi-generational money, where meaning your kids may not necessarily need it, and that may be going to the grandkids and really building over time. So I would posit this. Someone who's in their 80s, if that money is for someone in their 80s, they have a different investment strategy than someone in their 20s, right? So an 80-year-old's grandkid or in their 20s, you may have a completely different investment philosophy for that money. But these IRAs really can be a tremendous multi-generational wealth creator. And if it's a Roth, it's even that much better, because you really, as you'll see, well, as we've seen in other videos, you really don't necessarily want to be inheriting a taxable IRA, because all that money comes out 10 years after death, and it's all income. So that 500,000, if it grows to $1 million, you've just added $1 million to your income, and poof, it's a $500,000 tax bill in California. So that being said, Secure Act 2.0.
The Secure Act 2.0, this has been a rolling series of updates that are starting to change, get delayed. Some come out this year, some come out next year, some came out last year. And it's just been this kind of moving target of there was this massive piece of legislation passed with the initial Secure Act, an additional piece of legislation passed with the Secure Act 2.0, but most of the financial institutions and government institutions don't have the wherewithal to fully implement everything all at once. And so this has been a very phased approach. So I want to highlight what is new this year and might be new to you since the Secure Act 2.0. So the RMD ages, that was moved from 72 in Secure Act 1.0 to 73 in 2.0. And if you were born in 1960 or later, that required minimum distribution age is not until age 75. There is a reduced penalty for missing an RMD because of all these changes. The IRS has said, rather than penalizing you 50%, we're going to reduce that to 25%. So if you forget to take a required distribution, you are penalized for that. So that's important to make sure you're coordinating with your advisor on. Penalty-free withdrawals are available for terminal illnesses.
Not tax-free.
And
Hold on, not tax-free, penalty-free. This is the pre-59 penalty.
penalty-free, yeah, not
right.
taxes. The IRS still wants to get paid their taxes that have been deferred. So this obviously is with respect to pre-tax assets. If it's a pre-tax IRA or 401k, you can take that out with taxes, but with no penalty. So if you're under the age of 59 and a half, there's no penalty of that additional 10%. If it's Roth, there's no tax or penalty if it's for terminal illness or $1,000 for an emergency. But one of the things that is new, and I wanted to highlight this with all the fires and all the natural disasters, is you're able to take up to $22,000 if there's a federally declared disaster area. So if FEMA has declared your zip code, your county, a disaster area, or for someone that experiences loss, as long as you take that withdrawal within 180 days of the disaster event, then you can take that out up to $22,000 penalty free. So again, not tax free necessarily if it's a pre-tax asset, but penalty free. Employer payments towards qualified student loans, those are something that a lot of employer plans allow as well as a matching contribution. Rather than taking the match in the 401k, the employer can issue a check directly to a student loan. So that's also another benefit of many plans. And qualified charitable distributions is finally indexed for inflation. It was capped at 100,000 for many, many years. It was a little less last year. It's now a $108,000 limit per IRA owner for 2025.
So
And then,
married couple, they each can do 108,000 qualified charitable
correct.
distribution. Right.
Once you've attained age 70 and a half, and we'll cover that in greater detail. 5 to 9 accounts, if they've been established for 15 years and maybe not needed for college funding or higher education or trade school, then those 5 to 9 accounts could be transferred to a Roth IRA, but they are subject to the annual limits. And so there's some additional nuances there. But that's one thing that we have seen some clients do as well.
I would say the penalty-free withdrawal, if you've been affected by a disaster and need the money, and that's your sort of last resort, I would put that on the last resort bucket of money, wouldn't you, Christina? Because you do need, we're going to get through this, right? With natural disasters, there will be another tomorrow, and it's very important to also think about your retirement. And I know that can be very hard for somebody who's going through a tremendous loss. So many people that we've talked to have lost so much, or maybe they haven't lost their house, but it's been disruptive to their business, to their employment. But I would say that is probably. Would you agree with me that withdrawing from your
last resort
is last resort, right?
Or even quite frankly, taking a loan
Right.
at a low interest rate on the 401k, because you can take a loan up to 50,000 to the extent up to half of the 401k balance, no more than 50,000 you can take as a loan. And that might be even better as borrowing from yourself temporarily than taking a distribution, because you can't really easily put it back once you've taken it out of the 401k. I mean, there's some nuances there as well. Secure Act 2.0 additional updates. Again, the super catch up is one of those major changes this year. Not all employer plans allow for that. So you want to make sure that you've asked your employer and demanded that they have that super catch up if you are 60 to 63. RMDs on inherited IRAs will now be enforced. So if you
wait a minute, they weren't being enforced before?
They were not.
Right.
So essentially from 2020 to 2024, there was not concrete guidance from the IRS on what to do with the Secure Act 2.0 legislation. And so they kept kicking the can down the road. And so if you, prior to 2020 and prior to the Secure Act, if you inherited an IRA and were not a spouse, so these only really apply to non-spousal IRAs, you were able to and eligible to take out a lifetime annual distribution. Those were still supposed to be taken out, and those were being enforced. So if you were on a lifetime schedule,
right,
you were required to take out an annual distribution, and those were continuing to be enforced because those rules had been in place for a long time. Post 2020, you have a 10-year rule where you have 10 years to empty out that inherited IRA. And if the owner was already of RMD age, you're required to take out an annual RMD based on your life expectancy. So the amount you're required to take might be low, but you also only have 10 years to fully empty out that inherited IRA. So you don't want to wait necessarily till year 10 and take out a huge taxable distribution to the extent that it's a pre-tax IRA or 401k. So this also requires quite a bit of thought and care with a financial planner and your tax advisor. However, those annual RMDs are starting to be enforced this year. So when you might have inherited an IRA in 2021, not had to take a distribution from it yet, you're going to have to this year.
Yeah, and here's why. If this sounds like, wait a minute, the government's not enforcing a rule. The rule it was very much shifting sands. The government was not clear. There was not clarity. And
Right.
not only, so this is something you can understand, not only does the IRS have its rules, but each individual institution that is the custodian of that IRA has to have their own processes and procedures in place. And I will tell you, not all custodians, in my experience, not all custodians follow the laws as they should for whatever reason. I don't know. But can be very confusing for a client because when you say, well, gee, I heard what the rules are. I understand what the rules, but my institution's not doing this. They may not be following the rules.
And honestly, the custodians don't have the obligation to. What it
Right.
comes down to is the IRS has abdicated all responsibility to the client. And it's the client's responsibility. That's one of the things that we do with our firm is make sure that we're tracking those RMDs and the requirements and what the rules are so that we are ensuring that we help the client meet all those obligations. But it is something that can easily get missed.
There was a case in 2024, very sad case. Elderly couple had a self-directed IRA. So self-directed IRAs are under the same rules as an IRA if you do it with the Ascent Wealth Management or wherever. They had their self-directed IRA, $500,000 invested in physical gold. They took custody, right, and of the gold and put it in their safe. That was deemed a distribution. So they had a big tax bill. So there are a lot of rules. And just because a custodian is letting you do something doesn't necessarily mean that that is what the law requires. So just investor beware. I get caveat investor, I guess would be the.
Yeah, gold is one of those
one.
typical assets I would not. We've done some webinars on gold. I'm not a fan, but it's certainly not the best asset to own in that asset location of an IRA. So additional updates that are kind of kicked down the road. This was supposed to be in effect already, but the mandatory Roth catch-up contributions. So meaning that if you have an employer plan and they match 4%, 5%, 6%, whatever the match that the employer does, if you are age 50 or older, that matching contribution is required to be treated as taxable income to you and contributed to your Roth 401k versus your pre-tax 401k. So that a lot of big Fortune 500 companies pushed back because they don't have the mechanisms, and payroll doesn't have the mechanisms to quite yet facilitate that. And they requested another year. So that has been discussed, but has been delayed.
But more to come on that. So what didn't change?
Yeah, what still hasn't changed, and we all kind of expected there to be this rumored, limit on super IRAs and super 401ks, and you're going to have to start taking distributions if they're over 10 million or over 5 million, or limiting backdoor Roth contributions or mega, conversions. So if you have a large IRA and want to do some conversions to a Roth, there's no limit. And they didn't close those loopholes in the Secure Act and the qualified charitable distribution age, even though the RMD has been delayed for your RMD age. You can do qualified charitable distributions at the old RMD age of 70 and a half. So let's talk about qualified charitable distributions. We had a lot of questions on this the last webinar we did. And qualified charitable distributions, or a QCD, that is allowing those that are over 70 and a half. This works from IRAs or inherited IRAs. So you still have to be 70 and a half, but if you have a huge inherited IRA, you can also direct those RMDs or just simply do giving up to 108,000 this year to a charity. So a qualified charitable distribution must go directly to a charity, a 501c3. It cannot go to a donor advised fund. And so the other thing that is required is to keep tax records. So, for Schwab, we use Schwab Institutional as our custodian. They will show the distribution going directly from the IRA. It does not go at the client's checking account and then go to the charity. It goes directly out of the IRA to the charities. That is reported by the CPA. It is not necessarily in the tax document or the tax form or the tax distribution of the IRA on your 1099-R. It does not always reflect in the tax forms from custodians. It is oftentimes something that the client, the advisor, the custodian has to show the records. The CPA then reports it on the tax return. And so it's not something that if you just gave a tax form to your CPA that they're going to know you did a charitable distribution. So we want to make sure you're keeping proper records. I've certainly had to catch a few tax returns that weren't properly reported. The QCD, it is not includable in your income. So if your required distribution is 100,000 and you do 100,000 of a charitable distribution, you don't have to recognize that at all as taxable income. It goes directly to the charity and it satisfies that requirement.
And this is important because if you have that 108,000 as income and have other investment income, it may push you up into net investment income tax, which is taxed at 3.8%. Also messing with your Medicare
IRMA.
B. Yeah, so there are a lot of reasons to have it go directly. Now, I put here in inflation in air quotes because it went from 100,000 to 108. It's rounded up and rounded down, so it's not exactly inflation. And the way the government reports inflation is it's a consumer price index for urban consumers, which is not a lot of, physically is a very small part of the country. I was at a presentation this week and saw it. They ignore rural people. Housing has gone through the roof in urban areas. They don't even include the states of Wyoming, Montana, and Idaho. No county in those states is included in the CPI calculation, but you talk to anyone, or food, you talk to anyone in Idaho and they go, wow, housing is like tripled in the last 4 or 5 years. So I put this in air quotes here, inflation. This is something to pay attention to because I firmly believe that prices are going up faster than the tax brackets. So the amount of money that you're paying in tax is increasing over time because you're not getting the benefit, the true benefit of the actual increase in prices. And this is a little bit has to do with the difference between purchasing power parity, inflation, consumer price index, a lot of these complex topics. And you may think to yourself, Jim, I don't even know what you're talking about. But here's the thing. I think the government has a vested interest in underreporting inflation for a lot of different reasons. And I don't want to sound like a foil hat conspiracy theorist, but just understand and we had a comment on one of our videos the other day that said, oh, you're the first person who talks about inflation as a tax. So if you own an asset for a long period of time and you have to pay capital gains on that, if you bought something 30 years ago, you're paying capital gain on essentially the inflation adjustment. I don't want to go down a wormhole on this, but I put that in air quotes just so if you see the word inflation, I'm not sure that's exactly coupled with how people actually spend their money. So
Yep.
be that as it may.
So I think on the next slide, we might address this, and if not, I'll speak to it. But yes, a donor advised fund. So the donor advised fund, while a charitable QCD, cannot go to a donor advised fund. It has to go directly to the charity. That means the money has to go straight to the charity right then. While if you ever do contributions to a donor advised fund, those can just sit in the donor advised fund, continue to be managed for the benefit of charities. It always has to come out to a charity, but it could be delayed. The IRS on a QCD wants that money going either to you to pay taxes on or directly to benefit a charity at that time. So donor advised funds are not an eligible QCD. And you cannot have money go directly from an IRA to a donor advised fund and satisfy RMD. Now, donor advised funds can be named a beneficiary of a retirement account. So
after you die.
After you die,
right.
Yep. So I've got some clients where they've got no children, no heirs, and spouses are each other's primary beneficiary. They were reviewing their contingent beneficiaries. So if both of them had passed, who are the contingent beneficiaries? And a lot of them are older than they are. And they said, this is probably something we got to think about. And rather than having it go to the trust, which is going to, then maybe pay tax and then go to charity, it would be better to have it go directly to a donor advised fund if they don't know what charities they want to benefit. So it can go directly to a donor advised fund. You can have successor managers of that donor advised fund. So in your trust, you could name successor managers and say, I want these people to determine what charities are going to get checks annually or distribute it at all. But a donor advised fund can be invested. All the funds stay in the donor advised fund with no annual distribution requirement, can continue to accumulate and be for the benefit of any 501c3 and multiple. And so other things that people use donor advised funds for is to gift appreciated securities and not recognize the tax hit. So everything that goes into a donor advised fund, you get a deduction at the time of contribution. But once the money comes out of the donor advised fund to charities, you no longer get to double dip on that deduction.
Yeah, so this is interesting. If you have a very low basis stock, let's say you bought some Nvidia a while back, you bought it for almost nothing, and now it's worth $100,000, and you have 100,000 in the bank, and you want to support a charity for $100,000, you're better off making potentially better off making the gift of the stock, right, and then turning around and buying your Nvidia shares, $100,000 worth of Nvidia. You basically get a new basis on that stock, and then selling that Nvidia stock within the donor advised fund, or maybe you just give it outright to the charity. And that's a way of circumventing the wash sale rules, because you have not sold that stock. You gave the stock away. In this case, the Nvidia stock has been given away to the charity. It's the charity that sells the stock, or the donor advised fund that sells the stock. And now you have a higher basis on your stock. So it is mitigating income taxes or capital gains taxes in the future. And again, this is why it makes sense to work with a CPA, financial advisor, and lawyer, to make sure the money's going to the right causes, the right, people, animals, nature, whatever it is, but done in a tax efficient way that kind of looks more broadly at your overall portfolio.
Correct. Now, while QCDs are certainly an option, sometimes we also look at just doing, gifts to charities or a donor advised fund and what we call gift bunching. And this is just an example of clients that maybe used to take a itemized deduction, and maybe because the standard deduction is greater, they are no longer getting a deduction for giving to charity. There's some people that give $1,000 a month. They just have certain charities that are really important to them, but they may not actually get the benefit of that deduction, because the standard deduction this year for a married filing jointly is $30,000. And so if you gave a charitable gift of $10,000 and then had other deductions of $13,000, then you don't really get the benefit of taking that $23,000, because your standard deduction of $30,000 is greater. Now, if you were to, in option 2, gift $20,000 of charitable giving to a donor advised fund, give that appreciated Nvidia stock to the donor advised fund. Doesn't have to be cash, it can be stock. And if you got the market value get deduction of 20,000 and had additional itemized deductions of 13, your total is 33,000, then therefore giving you a greater deduction than the standard. And so you can basically, rather than giving 10,000 over the course of 2 years, put it all in a donor advised fund to the charity. You could still distribute annually, just like you are used to giving to that charity, but you're front loading that to get the better tax benefit.
I guess this is an example, Christina, of I think I would say, if there's a hierarchy of mistakes, maybe the mistake number 2 or 3 in income tax planning is looking at a 1 year slug of time. We are so culturally ingrained. We measure, every time the earth goes around the sun is 1 year. We are really hardwired to think about time span in a year, 365 days, January to December. A lot of tax planning is a multi-year analysis, and this is very
Yes.
counterintuitive. And this takes a lot of, frankly, takes a little bit more thought and planning that just people,
Yes,
even advisors, don't think about this. They're thinking year over year over year. They're not thinking multi-year strategy.
absolutely. So this is really where we have to rank, just directly to your point, is we have to rank what is the best solution. Is it giving cash? Is it giving a QCD? Is it giving appreciated securities? What's going to be the net result for the client? And is it a mix of both or all three? So that's really where doing the proper analysis of what specifically should we do in each of these giving strategies. And it comes down to, are you charitably inclined to begin with? Certainly. That is important, is making sure you're charitably inclined. But I also tell people, look, your charity can either be the government and then let them spend it how they wish, or you can direct it. And so it can be dual purpose as far as reducing your tax liability as well as benefiting charities. So as far as nearing retirement, these are all things that we look at when we're doing a comprehensive and holistic review of all factors of your financial situation. What, will be your continued savings? Should we do conversions? Should we, right before retirement, while you're working those last few years, should we do a pre-tax or a Roth contribution to your 401k? Should we look at real estate holdings? This is a big one right now for clients. I just got done doing a review this morning where client owns a lot of rental property. They are looking to divest that California rental property because the cash flow and the rate of return is so negligible now because of the cost of insurance or fire insurance or property taxes and just the maintenance overhead. So really looking at true rate of return on real estate holdings, in particular in retirement. And could we repurpose that for a higher income? And insurance policies, do we want to look at income replacement policies? Do we want to convert life insurance to long-term care coverage? These are all things that we should be looking at prior to retirement. What would happen if you have a long-term care expense? Would it bankrupt your spouse or potentially leave you with no income left to support a long-term care event? So having a proper income distribution plan is key. And then if there is, to the extent of future inheritance, what is the tax nature of those inheritances? Is important to look at too. It's not something you typically would think of as, I know I'm going to get this inheritance, but truly, what is the tax implications of those inheritances and how we put any thought into that? That's one of the things we want to look at as well.
I think reviewing your estate plan is very important. I would say we covered this in other webinars, but every 3 years is kind of a minimum sort of time period. I would say if you've had any life-changing event, births in the family, deaths in the family, divorces, if you are the victim of a wildfire disaster, and that is a time to reevaluate your estate planning. And because you may not be living in the same place in the future, you may decide to move, who knows? But that is an example of a big life event. Also, if you're in California and thinking about retiring out of state, other states have their own state death tax. Washington taxes your estate at 20% on amounts over 2 million, and Oregon taxes your estate at 16% on amounts over 1 million. So a lot of people are very surprised by this. Colorado is not a community property state, so that when one spouse dies, there's a question mark on whether you get a full adjusted cost basis on all your assets. So if you bought something for $1 and it's worth $10 and you move to Colorado and your spouse dies, you may be able to sell that for 10, but you're going to pay some capital gains tax. If you were a California resident, you might not have had to pay any capital gains tax. So very important to understand. What about using your lifetime gift tax exemption to take advantage of the high gift tax exclusion? Right now, you can leave essentially $14 million or gift $14 million tax-free.
Correct.
Unless Congress passes a law that the president signs, which is not a certainty. I mean, most of the smart kids are saying, oh, yeah, sure, it'll happen. But I don't think that's a certainty until it happens. Then that is scheduled to get cut in half to 7 million in 2026. So people ask me, Jim, what's going to happen? My answer is, I don't know. It's going to take an act of Congress that the president signs. And then how do you get your IRA, what we say qualified assets? These are that qualify for tax deferral is essentially what that means. That word means qualified assets. What's the plan for getting your assets to, if you have a very high income earning, you have an estate of maybe $1 million in cash and $1 million IRA, you have 2 kids, one child has special needs, right? Maybe on SSI. There is a use case for leaving the IRA to the child with disabilities and leaving the cash to the child without disabilities. And I'll be speaking in Napa in next month in February at a conference right on this topic. So how will annuities be treated on passing? Well, I think, will your charitable goals be fulfilled? But the annuities, Christine, I think a lot of people don't understand that an annuity is a contract. And so you put $100,000 in, you give it to an insurance company. They say if it rains on Thursday, then you get a return, or if the S&P does this or the stock market does that. Fundamentally, it's a contract, and the way that is taxed is if your $100,000 goes to $500,000 and your kid inherits that, there's a $400,000 income to that child when they inherit that annuity, and there are ways to spread that out over
There's
time.
ways to mitigate that. That's why we
Yeah,
spoke
yeah,
about inheritance, is understanding the tax implication of what potential inheritances are.
yeah. So it's not just estate tax. There's a lot of hidden
Correct.
income tax. Do you have an A team? This is like the '80s A team, right? BA Baracus. CPA tax advisor with your estate planning attorney and your certified financial planner. I would say when it comes to Roth IRAs, Roths and IRAs, the the CPA and the financial advisor are doing the heavy lifting. The lawyer is there making sure that the client's overall planning goals are met. But I would say the lift is with the financial advisor. And I don't know if you want to talk about, does it make sense? Well, how would people contact you, Christine, if they've watched this video? What do they do? Do they just give you a call? Do they email you? How does that work?
Call or email, and then if you email the team at My Ascent Wealth, then our staff will certainly make sure that there's a consultation booked, and we typically will do an initial 15-minute call, determine what your needs are, what your questions might be, and if there's a good fit, and then we'll book a more comprehensive consultation and do an initial complimentary consultation.
Ooh, is that free? That's great.
Mhm.
We have office locations in our firm, Northern and Southern California. And if you're watching this on YouTube, please don't forget to subscribe to our YouTube channel. Next time, settling a trust after death, dissolving a trust. So a lot of people want to know, hey, mom and dad died. We have this living trust. What do we do next? Do we really need a lawyer? Do we not need a lawyer? We're going to take a deep dive into that and discuss that topic. So it's a hot topic for, we mentioned inheritance. If you're thinking about settling that trust that your parents created, it's definitely worth a watch. We will open it up for questions right now. And if you have any questions, go ahead and put those in the chat or the Q&A. And then if you're watching this on YouTube, just keep watching because another YouTube video will roll magically after this one. Thanks for watching.